everyone. This is Tim Leveroni. I want to thank everyone listening to this market update call. Our goal is to educate you on the market environment and share perspectives from some of the investment managers we recommend. Shortly, I will introduce our speaker, Jeffrey Bookbinder. He will present LPL Financial's outlook on the current markets, interest rates, tariffs, and address some of the concerns of a recession. This call is being recorded today. There will be no questions during the call. If you have any questions, please call or email us. As Vice President, Equity Strategist, and Portfolio Manager, Jeff Bookbinder is a member of LPL Financial's Research Investment Management Committee. He was responsible for managing the LPL Research Equity Separately Managed Accounts and Tactically Mutual Fund and Exchange-Traded Product Portfolios, as well as developing and articulating equity and general market strategy with a focus on sector analysis. Jeff regularly communicates market strategy to LPL Financial advisors and is a speaker at LPL Financial conferences. Jeff also contributes to LPL Research's flagship publications such as the Weekly Market Commentary, Outlook, and Portfolio Compass, which is a monthly snapshot of LPL Financial's research views on the current equity, fixed income, and alternative investment markets. Prior to joining LPL Financial in July 2003, Jeff worked as an equity research associate for Stanford C. Bernstein in New York and Deutsche Bank in Boston. He has nearly 20 years of investment experience. Jeff earned his MBA with a concentration in finance from Duke University and a BA from Northwestern University in economics. He received the Chartered Financial Analyst designation in 2001 and is also a member of the CFA Institute. He currently holds the Series 7, 63, and 87 registrations. All right, Jeff.
Well, thank you, Tim, for that nice introduction. I'll try not to think about how old I am as we get started here. Has been a long time since I started my career here at LPL, and it's been a great ride. So what I'm going to talk about today is really the market outlook for LPL Research, focused mainly on equities, but also fixed income. Equities is my focus. And then hit on some of the topics that I'm sure many of you are interested in. Certainly the trade tensions and tariffs is a big one right now, and rising interest rates in the Federal Reserve, certainly a big one as well. And then really the question we always ask is, investors is when's the next recession, because that's certainly when you want to try to be more defensive with how you invest, at least heading into it. So let's jump right in. This is the mid-year outlook. Hopefully some of you have seen this. The slide presentation I put together today has some slides from the mid-year outlook, but a lot of them have been updated. So if you've seen this before, don't worry, we'll give you some new stuff. Certainly our design team does a tremendous job making this stuff look good and making it a little more engaging than some of the vanilla market outlooks that you see from others out there. If you go to the next, that slide here, the how to invest slide just shows you what we like, frankly, and what we don't like. This is how you make money. It's what do you own, right? GDP and the Fed, those aren't necessarily making anybody money. It's about what you own in portfolios. So I lead with that. The boxes in yellow are the equity areas. I'll get to the fixed income later. And on the left-hand side is stuff we like, the first two columns, and the right-hand side, stuff we don't like as much. So on the like column, you've got small caps, big beneficiaries of tax reform. You've got value, which has really struggled for a decade now, but we think the conditions are in place for some catch up here on the value side, and we started to see value do a little bit better over the last few weeks. We are tilting the portfolios we manage in that direction. And then cyclical stocks as opposed to defensive stocks, largely because we just think this economy keeps growing for at least another year or two, and possibly longer, despite some of the risks out there. Emerging markets, we just think the trade situation and tariffs, the market's pricing in too much pessimism with regard to China and Asian markets in general. So given how cheap the emerging markets are and the favorable demographics that you see there in terms of population growth and people entering the workforce and countries moving from sort of the, let's call it the third world to the second world, there's a lot of positive long-term trends there that we like. We still like the U.S. best and recommend clients with equity portfolios that are diversified to have the majority of those portfolios in the U.S. because it really stands out in terms of the economic growth, the economic momentum, and the earnings that we're seeing in the U.S. But we're certainly managing global portfolios, so we talk about the globe. This is our forecasts for GDP, inflation, and unemployment for 2018. We haven't really changed these much at all since we came out with them about a year ago. We think the U.S. can grow close to 3% GDP. That's about consensus. The developed economies overseas, probably more like 2. And by the way, they're slowing, which is a reason why we're being a little bit more cautious on developed international. Equities right now, although we certainly own plenty and recommend you own some in strategic portfolios. Emerging markets pretty close to 5% expected, despite the challenges related to the potential trade war with China. And then globally, almost 4% GDP. You see here, the U.S. is the one accelerating. Everything else is kind of flat down. So even though we're seeing solid growth in EM, it's not expected to accelerate. The U.S. really stands out. Inflation's picking up a little bit, but is not particularly worrisome to us at this stage. The Fed's preferred measure is still at 2%, which is their target. And unemployment, boy, the labor markets are really, really strong and continue to support consumer spending with the unemployment rate down under 4. Probably the most common question we get in the research department is when's the next recession? And certainly with the volatility that we're seeing here in markets and rising interest rates and the trade risk, those questions are coming in a little bit more frequently. So we still think this expansion has some runway, but it's probably going to slow down from what we saw last quarter. We had over a 4% growth rate for GDP in Q2 and probably settle into the high 2s, maybe 3 over the next several quarters. But we still think this expansion has room to go. You see here, we're almost at the longest one ever. I've got a few slides later in the presentation that highlight why we still think we've got a good amount of runway left in this expansion. But just point here is, just because it's been a long one doesn't mean it has to end. There are certain conditions that historically have had to be in place for economic expansions to end, and we just don't see them. One of our favorite leading indicators, the LEI, that's actually the name of it, the Leading Economic Index. It's a collection of 10 indicators that have shown some ability to predict economic growth over the next 6 to 12 months. They put all those together into this one index. And over the last 6-7 decades, it's had a pretty good record where you see on this chart that the index turns negative before recessions. We aren't seeing any sign that this is going to turn negative anytime soon. In fact, the last reading was up 6.4%. That's a really strong number. And we would expect that index to continue to show growth here going forward. Some other ways that we try to gauge whether a recession is coming, the ISM Manufacturing Index. It's a survey of businesses where the institute asks them if they're going to spend more or less in the future. And that reading typically doesn't get above 60, but it did last month. And the good news there is, well, it's at 59.8 in September. In August, it was over 60, 61.3. The good news is, even if you're peaking on the ISM, which we probably just did last month, on average, based on these last 5 economic cycles, you still have about 4 years to go before you hit recession. So we've got some time. And then the other piece of good news here, this is the bottom of the chart. The S&P 500, on average, is up about 60% during the time between the ISM peak and the end of the bull market. So, it's hard to say we'll get that much, but at this point, it's clear that from this signal, we got more stock market gains ahead. Another one that has gotten a lot of media attention is the yield curve. When the short-term interest rate is higher than the long-term interest rate, for this we use 2-year and 10-year yields. That has been an effective signal of recession. The good news here is over the last couple of weeks, the yield curve has steepened. As long-term rates have risen, 10-year yields moved to the neighborhood of 3.25. The yield curve steepened from about 18 basis points to, as of last check, about 34. So we're still on the flat side, but good news, we're steepening, and good news, we're not inverted, because if the short-term yield was higher than the long-term yield, you'd be looking at potentially just a couple of years before recession. But here again, another message from this chart is you have more gains to go based on history once the yield curve gets flat. The next slide, this is another hot topic here, tariffs. So clearly there's a lot of risk here if we get a full-blown trade war. Forecasts suggest that you could get maybe 1.5 points off of global GDP, maybe even more, if this escalates and essentially China and the U.S. stop trading with each other. And that is certainly not our base case and is very, very unlikely to happen. But if you take a more reasonable base case, maybe another round of tariffs go into effect, maybe the negotiations tougher than most expect. You're still looking at maybe $150 billion of tariff impact. That's still a pretty small amount when you compare it to the size of the U.S. economy, in the neighborhood of 20 trillion. And then when you compare it to the size of the stimulus that has been put in place for this year in the form of the tax cuts and additional government spending, even that outweighs the tariff impact. So this is a risk, and we don't want to dismiss it completely, but China and the U.S. will probably get a deal done, and the amount of economic damage is probably going to be pretty limited. You might take a chunk out of what the stimulus was supposed to do, but is highly unlikely to take all of it. And by the way, this chart doesn't even show repatriation. Companies can now bring cash back from overseas without paying additional taxes. They haven't been able to do that in the past. That is, in a way, a stimulus as well, as they put that cash to work that was previously tied up. Next slide just shows Q2 GDP, the contributors. The big blue bar is consumer spending. That's been very strong. We know that the labor market's strong. We know that wages are rising at a little bit of a faster pace. That's good for consumer spending, which is really the anchor for the U.S. economy. I guess the good news here, as you try to draw some conclusions from that 4% rate in terms of how it'll translate into Q3, we did have an inventory drawdown that suggests that maybe we can bulk up inventory in Q3, and that should support growth. But at the same time, you had companies rushing to get imports in before tariffs hit. And that actually boosted growth a little bit. That's other countries getting imports in, our exports out. So maybe you see that unwind a bit. nonetheless, consensus is around 3. That's probably where we'll be. This slide just shows the our views of the U.S. versus international developed and emerging markets. So I'll just reiterate, as I said up front, U.S. looks the best to us based on economic and earnings momentum. And by the way, we don't think stocks are that expensive in the U.S. And then emerging markets, we think too cheap, and we like some of the long-term growth and demographic trends there as well. So let's turn now to the bond market. I'm an equity guy, so I won't spend a lot of time on the bond market. I never do. It's not that exciting anyway. It's been a really tough run here. The last 2 years for bonds have been about as bad as any period in history. Bonds don't have too many bad years. I think there's only been maybe 4 since the Barclays Ag was incepted. So, but we are looking at one this year. We're down about 2.4% year to date. This is the now the Bloomberg Barclays aggregate, which is the broad bond market benchmark. And the 2-year run, which is the chart you see here, we're now down 1.4% over the last 2 years. Now, your portfolios have probably done better because you don't just own the Barclays Ag, which has a lot of treasuries. You own more corporates, most likely, and some other stuff like bank loans and high yield bonds, maybe, that aren't included in this benchmark. But nonetheless, it's just been a challenging couple of years as rates have risen. So what do you do when rates are rising? Well, you want to be a little bit shorter duration in terms of your interest rate sensitivity, and you want to be in some of the asset classes within fixed income that do better when rates rise. So here you see high yield and mortgages tend to do quite well when interest rates are rising, and then treasuries not so well. Investment grade corporates, certainly you can get shorter maturities on corporates, but if you just buy the benchmark type IGCs, you're going to end up with some duration, probably a little more than the benchmark, and that actually can drag on returns too. So that bond sector doesn't have a great record with rising interest rates, at least based on the broad benchmark. So when you talk about interest rates, you certainly have to talk about the Fed. So you see on this slide the dot plots from the Federal Reserve Open Market Committee. The members of the Fed project where they think interest rates will be in the future. And certainly there are varied opinions. The key point here on this slide is that based on where these dots are in 2019, the Fed expects possibly 3 or 4 more rate hikes before the end of next year. And if you compare that to where the 10-year Treasury yield is, I mentioned the yield curve earlier, there is the potential for the Fed to invert the yield curve and overhike. So that is something certainly that we'll watch closely. The Fed probably pauses at some point between now and the end of 2019. The market doesn't think it does 4 more hikes between now and the end of next year. Certainly, typically, the reality is somewhere between what the market thinks and what the Fed thinks. So certainly a risk to markets, but one right now that we're fairly comfortable with given where the economy is and the level of interest rates. So, this probably shouldn't have been a surprise to anybody, these interest rate hikes. We've now had 8 this cycle. Really, all you have to do to figure out where the Fed funds rate is going to be is to look at the height of Fed chairs. So we started, Paul Volcker, late 70s, comes in at right around 6'8", and interest rates were high. He broke the back of inflation with dramatic interest rate hikes from very high levels. Then we moved on to Alan Greenspan, who is more average height, a little under 6 feet, and of course rates kept falling. Then we go to Ben Bernanke, who is somewhere around 5'8", so we are moving down in height and in rates. We go even further. rates down even further with Janet Yellen, who is probably about 5 feet tall, even with some heels. So that's where we bottomed in rates. And now look what we have. We have Chair Powell, who is similar height to Alan Greenspan, close to 6 feet tall. And what is happening? Interest rates are rising, just as simple as that. A little bit of a lighthearted look at the Fed, but certainly an interesting correlation to follow there. So let's sum up bonds and move on. The areas that we like: bank loans and investment-grade corporates, although, again, important with investment-grade corporates to watch your interest rate sensitivity. So we're favoring corporates that are a little bit shorter duration than the broad bond market benchmark. Bank loans, which certainly benefit from the positive economic and corporate backdrop, and plus they are one of the best performing areas of the bond market when interest rates rise. So that's another favorite. And we're still holding some high yield bonds in our portfolios and recommend you hold modest exposure as well if that's consistent with your risk tolerance, because high yield tends to do very well as interest rates rise. We've pared that back, but we still have a little bit in the portfolios that we run. And then mortgage-backed securities tend to do well when rates rise as well. And we think you get a pretty decent trade-off between the income they provide and the interest rate sensitivity that you have to accept. And then similar to the equity side, developed international, not an area that we are focused on right now. And then long-term high-quality bonds in general, such as a 30-year treasury, not something we really want to own right now. And you don't have to. You don't have to own treasuries that long because you're getting comparable yields at a lot shorter maturities. So we would not take that much rate risk here. So let's go back to stocks here and a little bit more about recession outlook. The bull market is the longest ever now based on how we measure it, but it's not the most powerful. As of last check, we were up about 325% on the S&P, but in the 90s, the bull was almost 420%. So yes, it's a very long bull market, but based on how powerful it's been, we don't necessarily think it's going to end. But as I mentioned earlier, we look at a lot of these indicators that tell us when we might have a recession or if one's coming soon, and we just don't see it. This is a collection of a bunch of different economic indicators that we can tie to cycles, and these are various indicators. You've got some labor indicators, earnings indicators, inflation indicators. Throw all these together, and we get sort of a mature, economic cycle, but not really an old one that's showing signs of cracking. Profits are showing signs of aging, maybe the unemployment rate, but generally speaking, we're not really showing signs of a peak that suggests the economy has to roll over right now. This next slide, the over-index, is something we created to try to gauge excesses in the economy. So are we overspending, are we over-borrowing, or are we overconfident? So the easiest example of overconfidence was probably the late 90s in the tech bubble. The easiest example for overborrowing was probably the subprime mortgage crisis and all the leverage that caused the Great Recession, or at least caused it to be so deep. And we're certainly not overspending right now. We certainly don't have the characteristics of 2007 or 1999 right now. And you can see by this index, we're not in the trouble zone. So that's encouraging. Here we've got some other indicators that tell us there's really not a whole lot to worry about here based on the yield curve. I mentioned some of these already, leading economic indicators, et cetera. The one that's highlighted here as yellow and on watch, we call these our 5 forecasters. The one that's a little bit maybe toward the cautious side is valuations, but PEs are, for the S&P, have fallen down to under 17. So that's a little above average, maybe 1.5 points above average. So yes, it's a bit high, but given where inflation and interest rates are and given the overall macro backdrop, we think those valuations are fair. So we're getting some volatility here in markets. Most important thing for investment professionals is over time to not get scared out, because over the long term you tend to do better, certainly if you avoid selling at the bottom. And so these next two slides highlight that concept here. Midterm years especially, when you get volatility, we tend to bounce back really strongly after that trough. So maybe we're starting to get a little bit of election volatility right now. Could get a little bit more. October is a volatile month. But you can see here, the bottom half of these charts in the darker shaded green show the corrections that you get on average during these 4 years of a presidential cycle. We're in the midterm year, of course, and so you tend to see mid-teens corrections on average. But the top half, on a more positive note, shows the gains that you get on average in the S&P after the trough during the midterm year. So hopefully we've already troughed, but if not, hopefully we trough soon, and then we can start this rally. Once the market gets clarity and it knows the election outcome, investors tend to like investing in that environment, and markets tend to rally. Sort of a similar concept here on the next slide. You see, we get a lot of good years in the S&P. I mean, we all know that. Years are up more often than they're down. But what's really interesting here is in these little orange dots, you see the correction, the max drawdown that you get during the year. So there are a ton of years here that are really nicely positive, but they have corrections, 10, 15%, even more in some cases, for positive years. We've basically done that every year of this entire bull market. We've had a lot of good, certainly good years, some better than others, but a lot of good years, and we've had some pretty meaningful corrections. Not in the last year or two, but certainly this shows that stocks can do well despite volatility. We're coming up on earnings season, so it's a good time to highlight this chart, I think. Earnings growth may be peaking, and that's been something the media is focused on to get clicks, but it's important to make the distinction between earnings levels and earnings growth. So while earnings growth may be peaking, it's over 20% for the S&P, which is really, really strong. Certainly a growth rate like that is not expected to be sustainable. But earnings are still going up, and we still have the makings of a solid earnings growth year next year as well. Even if we assume that earnings growth is peaking, here again, this sounds familiar to the points I made earlier about the ISM and the yield curve. You still have several more years to go, based on history, before the market cracks. And so here you see average close to 60% gains in the S&P after that earnings growth peak, because earnings can continue to grow for several years after that peak in growth rate is in. Earnings have been growing globally. The U.S. has certainly been the strongest. You can take out the tax benefit here, and you're still looking at low teens earnings growth rates for the S&P. Really, really strong. We'll probably get something in the low 20s this earnings season. If you back out the tax benefit from tax reform, you're probably going to get something around, call it 15, maybe 16%. Still really, really strong. Much better than international markets are producing. But those areas are growing too after really a several year long earnings recession in international markets. So good growth in earnings internationally in 2017, more growth this year, and probably more growth next year as well. So rising rates, a big concern for many. That is probably the biggest reason for the recent volatility, although certainly the headlines on China and trade may be causing some folks to get a little bit nervous as well. But here's a chart that shows that stocks like rising rates in general. You see here over the last, call it 22 years, if you just pick out the periods where interest rates have risen most and look at how the S&P has done during those periods, on average, we're up about 6%. Actually, that goes back farther. We're up about 9% in recent decades. If you go back to World War II, we're up about 6% on average. We took this back all the way, I think, into the 50s. So the point is, you should not sell stocks because interest rates are going up. One condition, though, is interest rates have to be going up because economic growth is improving, right? Inflation has to be rising because the market's pricing in a better economic growth outlook. That wasn't the case certainly during the inflationary spirals of the 70s and early 80s. Interest rates are historically low. Inflation is still historically low. So this is an environment we think where stocks and yields can rise together. That said, if interest rates spike in a short period of time, that's when you get volatility. We saw that in the taper tantrum in 2013 when markets first started to get worried about the Fed pulling back on quantitative easing and all of its bond purchases. We're seeing a little bit of that today. In general, we would say volatility related to that at this stage of the market cycle should be bought, not sold. So it's been a bit of a challenging year, certainly for emerging markets, an area that we know does tend to be a little bit more volatile than U.S. markets over time. But we're sticking with them. And here's one of the reasons why. Historically, you tend to get big swings in EM in both directions. So this chart shows that when you have positive years, which are in yellow here, quite a few positive years, you tend to get pretty big pullbacks during those years as well. So some of these pullbacks or corrections are 15 to 20% or more, and you can still see here that EM can be up. So it's hard to predict that EM is going to be up for the year based on the MSCI Emerging Market Index, but certainly we think the conditions are in place for EM to snap back. The biggest catalyst we think is going to be an eventual agreement on trade between China and the U.S. The negotiations we think are going to really pick up speed after the midterm elections, and it's hard to say whether they'll be concluded by year end, but we think we'll probably have a framework for a deal by year end, and that should help emerging markets start to turn around performance. The next slide is it highlights one of the positive developments in emerging markets here over the last month, and that's positive earnings revisions. So earnings estimates for international companies have been falling most of the year. Part of the reason is the strong dollar, which weighs on overseas profits. But certainly there have been economic reasons as well. In developed foreign markets, that trend hasn't really changed. Estimates are still falling. The U.S. estimates are marginally higher, but they've kind of leveled off. But look at emerging markets. They've actually seen positive revisions. The estimates for emerging markets have been rising over the last month, and we think this is a real positive development. So along with the positive economic growth outlook, along with favorable demographics, we think the earnings picture is getting better. Valuation's very attractive, and so we think it makes sense to stick with emerging markets here. So I will go ahead and stop there and turn it back over to Tim. Tim, thanks for having me on to do this, and I hope that was helpful.
Thank you, Jeff, for your thoughts in the current market environment. I really appreciate that. As a reminder, if you have any questions, please contact us by calling 781-848-9821 Again, that's 781-848-9821, or visit us on the web at www.leveroni.com. That's www.leveroni.com. We'd also like to hear some feedback to help us improve the format of these calls. Also, if you know of anybody who would be interested in hearing about our market update, you can forward this email to them. And once again, thank you for your continued confidence.